Hi, everyone. Welcome to Wharton Tech Talks. I'm Manasi, and I'm joined by my co-host, Julien. Thanks so much for listening in today. We're also joined by Cassie Miao, who is the Director of M&A and Ventures at Databricks, the leading data analytics and infrastructure platform that has raised over $3 billion in capital and was last valued at $43 billion. As part of her role, Cassie leads Databricks' evaluation of and investments in innovative businesses focused on the data lakehouse ecosystem, including Hex, Labelbox, and Prophecy. Prior to joining Databricks, Cassie was a director of Corp Dev at Twilio and a director of M&A at Salesforce. She began her career in TMT investment banking at Cowen. Cassie received her bachelor's degree from Rice University. Cassie, thanks so much for being with us today.
It's great to be on. Thanks for having me.
Great. Well, we'd love to start a little bit with your early career and start. So after your work in investment banking, you transitioned to doing Corp Dev at RPX to start. Could you talk a little bit about how you came across Corp Dev as a potential career path and how you were thinking through your options coming out of investment banking?
Absolutely. So I entered investment banking knowing that it wouldn't necessarily be a long-term career for me and didn't necessarily fit what I was looking for in terms of career development over the long run. But I felt, and I still do feel, that it's a great career for someone who is starting out or is interested in entering into financial services or adjacent roles. It's such a great training ground, and you get to learn at the broadest levels of industry and also learn the fundamentals of financial analysis and modeling, which I think is a great skill set to have. But going into my second year of banking, I started thinking about other opportunities, and I landed on corporate development more by chance. One of the philosophies I've had, and that has worked really well for me throughout my career, is just to follow leaders and manager who you work well with, who you respect, and whose careers you respect. And I took that approach when I left banking and joining one of the managing directors I had worked with in Cowen to go to RPX, where he was heading up corporate development. So I knew relatively little about corporate development, and I think in some ways it benefited me because corporate development can mean a lot of things at a lot of different places. And to go in with a beginner's mindset about what I would be doing worked well for me at RPX, who was a growth-oriented, more of a startup type culture. So corporate development there meant doing a lot of ad hoc projects for the CFO and supporting growth at a higher level manner versus focusing specifically on M&A or your traditional corporate development opportunities. All that to say, corporate development can mean a lot of different things based on the industry, the size of the company, and also how the group is set up. But I think if you are considering a career that leverages financial analysis similar to banking, but in an operating company where you are really aligned with the strategy of the company you're working for and get to see processes and beyond into what comes out of some of the acquisitions, investments, or partnerships that you do, it's a great way for people who love combining the technical elements with more of the operational and strategic elements of investment banking.
Yeah, that's super helpful. Thank you. And I think a lot of our listeners have probably been more familiar with the traditional institutional investor model where your capital comes from the LP base, but you're kind of responsible for establishing your investment mandate and choosing where to spend time. In comparison to that, on the corp dev side, what is the involvement with kind of company management, A, in sort of setting what your mandate and agenda for a year or 5-year period is, and B, in regards to deciding where you're going to spend time, whether or not that's like a specific industry or business model or something else?
Yeah, I think it's both a tops down and a bottoms up approach at a corporate role. There is obviously opinionated views from management, from executives, and tech specifically, the product and engineering leadership. So there is a lot of institutional knowledge there because they do interact with companies in their space. They hear about new startups being founded. They might be connected and have relationships with a lot of the network that you would naturally be exploring in your role in corporate development. But there are gaps to what they see as well. For the most part, management is operating on a build versus buy or partner type of perspective. So there is a lot of value to someone in corporate development being in touch with the startup ecosystem, the venture ecosystem, and tapping into the founder network on a ear to the ground level so that you're surfacing interesting opportunities that management may not have thought of or have been connected with previously.
Got it. After your role at RPX, you transitioned to Salesforce, and you were there at a pretty interesting time from 2015 to 2021. It was a really healthy investment ecosystem overall. And from what we understand, Salesforce has been one of the most active corporate venture programs globally. Could you just talk a little bit about sort of domains that you were focused on specifically during your role there?
Yeah, definitely agree with. It was a really exciting time to be in corporate development, especially at Salesforce. And it was a great way to learn about different elements of corporate development, given how active we were during that period and how broad of a scope we had. So in corporate development, the team was split into M&A, ventures, and integration. My mandate was almost primarily M&A, although the M&A team did help out with strategic venture investments in nature that align more with M&A versus corporate CVC. And within both sides of the house, so M&A and ventures, we tended to start out as generalists covering all surface areas that Salesforce was operating in, as well as adjacent and new TAM areas. The venture team began to focus more along kind of either vertical specific, geo specific, or product specific lines a little bit earlier than corporate development or M&A corporate development. M&As remained more as generalists throughout my tenure, given just it's hard to load balance without people being generalists because you typically don't know what area your next M&A opportunity will come. And the process tends to look very similar no matter what industry or vertical that you're operating in. Our scope was quite broad, and in my 6 years there, we focused on a lot of different areas from smaller technology gaps that we could plug to what we call TAM expansion opportunities, where we're going into a net new area for Salesforce. Both of those strategies kind of ran in parallel. And so when you look back on the acquisition history of Salesforce at that time, you do see a fairly regular cadence of smaller acquisitions along with public company acquisitions, the likes of MuleSoft and Tableau and Slack. And it's a great way, I think, for us to be able to offer the best new technology as well as stepping into newer areas that were adjacent to our customer user base while at Salesforce.
And stepping back a bit, I'm curious, we have a class here called Management of Emerging Enterprise. And one of the things we talk a little bit about is like when a company's looking to enter a new market, do they do a partnership? Do they do an acquisition? How does the context of that new market affect their decision making? So from a large corporation's perspective, when do they typically decide to launch a corp dev department or really invest resources in active M&A and venture investments? Does it have to do more with kind of the scale of the company, kind of balance sheet, cash availability naturally, or something else?
Those I definitely think are big factors. And I think corporate development doesn't necessarily start out with a clear mandate, and a lot of times evolves from people working on BD, working on partnerships, thinking about creative ways to bring those parties closer to your company. And when the first kind of M&A happens, that actually isn't done by, from what I've seen, a established corporate development team. Usually that's actually done by just business folks who are helping out with an acquisition. And I feel like a lot of the success of your first few deals determine kind of your strategy and your philosophy around M&A is very hard to complete successfully. And I think there's a lot of stats in the market around this. But for companies that do find success with earlier M&A deals, I feel like there's more of an appetite, especially at the executive level, to continue champion that as a way to grow. And I think M&A deals are especially effective if you are a true platform, which Salesforce was and Databricks is as well, in that with a true platform, buying a new technology or new product, it's very easy for you to be able to integrate in a way that your salespeople, and I'm focusing more on B2B now, but in the way that your salespeople can barely go out and sell to existing customer bases. So in that kind of motion, M&A makes all the sense in the world to continue doing as long as you have the resources supporting it. So to your point about having the cash reserve and also macro climate that supports it.
Really helpful. Switching gears a bit to Databricks. So you've been a director on the M&A and venture side for almost 2 years at this point. Could you share a little bit about how you thought about joining and kind of what drew you to the organization?
Definitely. So to my previous point around often joining companies because of managers and leaders, my previous manager at Salesforce and also a colleague that I had worked with at Salesforce joined Databricks about a year before I did. And they were both very excited about the opportunity in the same way that I was, in that they were excited to go to a growth-oriented company that was operating very much as a startup. So moving very quickly on opportunities, thinking creatively about problems, and having a beginner's mindset when it comes to not only deal making, but just growing as a organization. Hearing about their experience, which matched very well with what I was looking for in a new opportunity, was what first drew me to Databricks. And in learning more about Databricks and its differentiators and the way that it is going up competitively against other players in the market made a lot of logical sense to me. And I saw a lot of upside in Databricks' growth trajectory. In meeting with a team, half of who I kind of already knew and half who I didn't, and learning more about the opportunity that Databricks was going after as a company, it was a really exciting opportunity to me and what fit what I was looking for at that time.
Databricks is unique because aside from having kind of this M&A option, they have a dedicated ventures arm. As it stands, how does Databricks think about like the mix of their funds they're looking to make allocated to direct venture investments versus M&A? Or is it a bit more, we're going to look for the best opportunities and based on what deal makes sense, we'll proceed in either direction?
It very much is a strategic decision for Databricks, and Databricks corporate development encompasses M&A, ventures, and a technology partnership team. So those are all housed under M&A, and it very much is kind of all the different options in ways that we can work with external parties. So having that as a channel to go out to talk to companies and find the best fit for companies in the ecosystem that we want to work with has worked really well for us. So when we approach a discussion with another party, we don't always have in mind a specific kind of path we want to slot them into. It's about learning about the company, learning about how they go to market and how that might work with Databricks, and finding the best path forward in terms of these three options. And maybe it's even a combination of these three options. It very much is a strategic decision on our end. And the partnership funnel has created really good opportunities for us in both potential venture investments as well as M&A. Working collaboratively with those targets across a spectrum of different options is really beneficial to not only the counterparty, but for Databricks as well.
Okay, very helpful. And then talking a little bit about Databricks venture mandate. So on the website, it said the mandate's to invest in young companies developing data and AI systems that work with the parent Databricks Lakehouse data repository and analytics platform. So part of my interpretation of that is we're looking for really innovative companies in this overarching data space, but ideally there's some synergy or some partnership opportunity with the existing Databricks platform as well. So A, is that interpretation correct? And could you elaborate a little bit on how Databricks narrows their investment landscape?
Absolutely. I definitely think that's correct. And we can go in with the approach of what is the better together story here. Again, we're not investing for financial basis. It's very much a strategic motion for us. So we're looking for companies who are plugging gaps or customer problems that we might not be tackling or we're not as focused on. And a lot of those opportunities, as I mentioned, do tend to come from partners that we are working already with. Partnership isn't a necessary mandate that we need to have when we're evaluating investment opportunities, but it's a great signal to us that there is a better together story here. So we look at it from that is there potential to partner and work together angle, and we also look at it from a broader landscape perspective. Databricks is in many markets within data AI, but there are a lot of areas that we haven't had time to focus on, and solutions and tools that our customers are looking for we might not be offering. So the partnership motion along with the investment option is a great way to tap into companies who are filling that gap and encourage them to work more closely with Databricks. So with the Databricks investment comes, for the benefit of the counterparty, our vast go-to-market motion, our branding, and ability to work more closely with us to be able to integrate at a technological level. And for Databricks, we're looking for companies who, again, can plug customer gaps or who are on the frontier of some of the newer technologies, especially on the AI and Gen AI side of the house.
I guess one element in the venture world is sourcing investment opportunities. And I know some institutional investors take a very volume-based approach, sending a lot of emails. Some are more thematic in nature, so keeping tabs on subsegments they're excited about and then having relationships with top companies in that space. How do you at Databricks think about sourcing, whether it's through some of your kind of existing corporate channels, using some of those traditional institutional methods, or some other methodology?
Yeah, that's a really interesting question because I think sourcing for CVCs has changed a little bit in the past few years. I think when CVCs first started out, it was challenging to get into rounds because institutional investors didn't know how to think about working with CVCs. In today's day, I feel like a lot of rounds that are being put together by institutional ventures, they do want one, two, or even more strategic corporate venture arms in there to help with some of the operational side and the go-to-market motions of these startups. So sourcing in the past few years for most companies who are focused on CVCs actually has been easier than years prior. I think there is a lot of connectivity with the corporate venture arm and institutional players, and they work together to evaluate opportunities. And sourcing also comes naturally from our executives. Databricks is unique in that we have 7 co-founders, so we have a lot of eyes towards the landscape and interesting parties in the ecosystem. And then we do a lot of footwork as well in learning about different ecosystems, understanding the market map to identify interesting targets others might have missed, going to events to meet startups and founders, and making sure that we're building the relationships so that even if investment isn't a path that we're taking in a current raise, that we're being considered for future raises. I would say the main avenues are working with institutional investors, leadership, and product and engineering champions within Databricks, and the corporate development team does some footwork as well and bring new opportunities to light.
That's really interesting because having this product and customer leadership within the org also adds a nice angle of advantage in the investment process, because I assume you have a lot of institutional knowledge and product familiarity that maybe traditional investment firms wouldn't have. When you're doing a diligence process, are there areas that you tend to index on more than maybe some non-CVC investment firms, or areas that you just approach differently in a diligence process compared to how other investors might think about it?
Yeah, I would say one metric that is a little bit more unique to Databricks is I mentioned that we have a very vast ecosystem of technology partners. And in the way that technology partners integrate with us, we actually get to see usage patterns across our joint customer base. And this creates really valuable data for us when we're thinking about both new subsegments within data and AI and also in evaluating specific targets. That usage pattern and trend line. So is it increasing? Is it decreasing? What type of customers are using this product? What segment of customers are using this product? Those type of data points have been really helpful and something that we try to look at if possible when we're evaluating new opportunities.
Great. I'm going to go ahead and take it from here. So thank you so much, Cassie, again, for joining the podcast. Given your role in the corporate development at Databricks, you probably see a lot of different trends and a lot of different startups. So maybe what are items or the areas that you're most excited about in the data and AI world from an investment standpoint?
I think my answer will be a little bit boring because it probably aligns with what a lot of earlier stage investors are looking at nowadays, which is Gen AI. And it definitely is in its early stages. And I think there's a lot of maturing and probably consolidation that will happen in the market over the next few years. But it's a interesting market to us because Gen AI foundationally requires a lot of data and a lot of compute, which is what Databricks is focused on. And being able to bring Gen AI and its adjacent technologies to our customers is a really exciting opportunity for us. We're doing a lot of work around understanding what the most interesting players are, what the frontier technologies are, and how that would potentially integrate with Databricks. So not only are we thinking about it from a corporate development standpoint, there is a lot of time and energy spent at the corporate level to understand this ecosystem and how we play into this landscape.
Are there maybe some areas like since the rise of Gen AI that have become less interesting or less exciting from your perspective, from Databricks or an investment perspective?
I think it's made a lot of, I would categorize unsexy use cases a lot more interesting in our mind. One example is data pipelines or migrations. That has been a subsegment that has always been interesting to Databricks because being able to move data into Databricks platform, being able to create data gravity within our platform is very important to us. But now there's a new way of doing it, both in terms of user workflow and in underlying technology. The way that we think about migration and data pipelining is now turning a corner because of the advent of Gen AI and its capabilities. I think, if anything, it's kind of broadened our horizons around what are the future use cases and has us thinking very creatively around actual customer use cases that is applicable to our enterprise customers.
And then can you maybe walk us through some of like the theses behind some maybe your more important recent deals, such as the investment in Mistral, Unstructured, or Perplexity, and maybe what was unique elements in each of those businesses that you thought would make them either a great venture partner for Databricks or eventually maybe even a great M&A partner?
Definitely. So Mistral was an investment we closed a few months ago. They're a open source foundational model company based in Paris. And that was an especially exciting one for us because Databricks comes from open source technology. We're built on open source Spark. And the open source narrative is one that we champion quite a bit with our customers because vendor lock-in creates huge problems both financially and technologically for a lot of customers. And so having open source technology for customers to use and give them choice of avoiding vendor lock-in is a philosophy that Databricks always champions. That vision aligned really well with Databricks' core vision. And with Mistral being based in Europe, that also was a very interesting differentiator for us because, as many people know, Europe is the leading player in terms of thinking about data and data privacy. And that is obviously a concern to a lot of people who are seeing the advances of Gen AI and of the power that it has. There's also potential for misuse, potential for security, privacy, and other breaches. So working with a company that is thinking very heavily about the privacy and security implications of foundational models and based in a place where there's a lot of oversight and regulatory consideration when it comes to these models provides us with really valuable insight and data. That was a particularly interesting one for me to work on.
And then I imagine Mistral, like many of the other deals in Gen AI, are incredibly competitive, probably the only sort of companies that are really raising competitive rounds right now. So maybe what is Databricks' pitch to be an investor and get a seat on many of those competitive financing rounds?
That's a great question. I think we have really great brand awareness as Databricks. in how long we have been operating in the AI and ML world. So our focus on big data sets is really useful for people who have been working in ML, so very traditional ML, as well as newer AI workloads for many, many years now. We have that legacy into tapping into these types of user bases and user personas in a way that a lot of our competitors don't. And we have, again, always championed open source, which very much foundational to Mistral's corporate goals and corporate philosophy. That alignment has existed from the very beginning. And I think it was very natural for Mistral to consider Databricks as an investor when they're looking at strategic investors they want to have on their cap table. Our CEO, Ali, is close with the entire network of researchers and the people who are at the forefront of this technology, given that we come from a very academic origin. So Databricks came out of the Berkeley AMP lab and has deep ties into academic elements of this technology, which when you're looking at foundational models, a lot of the people who have started or are working at these companies have been researchers and academics in their prior life. Knowing those types of backgrounds, speaking that language, also helped to establish a relationship of understanding and trust.
I think now we'll move over to sort of like the career advice section, given that we are an MBA podcast. And I'm sure a lot of our listeners want to end up in corporate development, either at a tech company or in other companies. So the first question that I have for you is, what skills are most important for corporate development? We've already hit on sort of your background in banking, but anything that's sort of like really unique from corporate development in comparison to being an investment banker or maybe an institutional investor that you think is relevant?
Definitely. I think there's two, maybe three elements of that, depending on how you cut it. The first is understanding the financial and process aspects of M&A. And traditionally, I think a lot of corporate development folks have come from investment banking, specifically M&A investment banking, and that's a skill set they would naturally have. But at Databricks are open to different types of backgrounds, and I think more and more corporate development teams are open to having non-investment banking, that kind of your traditional finance backgrounds as potential candidates for corporate development. And that's something that you can definitely work on, practice, and learn on your own as well. But having an understanding of those kind of financial fundamentals is critically important because you will be stepping into a process and expected to learn how to build a model, expected to understand the terms of a term sheet and the different milestones of a M&A process. The second is, I think, a little bit harder to just learn on your own, but it is understanding how to operate cross-functionally. From people who come into corporate development from traditional financial services, that's probably not an experience that you've had because you're used to working on very defined deal teams. There's a clear separation between you as a kind of financial services provider and your client, and everything is very much organized and operates in its own lane. When you're running M&A within a company, and as corporate development, you do not have that type of structure. You're managing probably 7, 8 upwards of that of different teams. And then within those different teams, there are people in different roles. So taking, I would say, finance team as an example, you loop in finance, but there's accounting finance, there's FP&A finance, there's tax finance, there's strategic finance, there's sales finance. And being able to work with a lot of different people who have possibly different goals and different personality is I think, interpersonal and soft skill that you should either work on and also enjoy kind of working in that environment if you're considering corporate development. And the third element, I think, is you want to be in a place where you are willing and excited about constantly learning. As corporate development, you have to understand all of the different functions and elements of acquiring a company at the high level. You'll be supported by subject matter experts at a deeper level, but at a high level, you need to understand legal terms and legal contracts. You need to understand financial aspects, tax planning, employment agreements, real estate policy, and the list goes on and on. It's not a role where you can expect to learn everything you need to know in the first few years and then you are just running the process. It's very much a dynamic and iterative process. And to be able to enjoy corporate development, you need to be someone who has that learner's mindset.
Great. The next question I have is related to obviously going from Salesforce to Databricks. They're both tech companies, but they operate in incredibly different domains. So how did you maybe get up to speed rapidly in terms of the data and Gen AI world that was really relevant for you now at Databricks versus maybe some of like the more traditional CRM world at Salesforce? And how did you kind of get up to speed on the actual content matter?
Yeah, that ramp is definitely a challenge. Salesforce is very much higher in the stack, app level technology. Databricks is very much deeper infrastructure, deep data technology. So the transition there is definitely challenging. And I'm starting from the very beginning when it comes to learning about the tech and the ecosystem. I think there are a lot of resources though, as long as you are willing to take the time and spend the energies and calories to ramp on the space. I think internal resources are the best way to go. So tapping into the product management team is especially helpful because they also operate very cross-functionally and they understand technology and also the non-technological elements of the product. User personas, user journeys, those are very helpful to understand as you're ramping on a product. And then in addition to internal resources, the venture community is really helpful as well. Most venture firms are now specialized in certain areas of technology, and finding the right people to have conversations with and to work with is really helpful in that they do a lot of the landscaping work and the thesis-driven approach of looking at a specific segment or subsegment of technology. And then third is just doing your own work there's a lot of resources online, blogs, podcasts, even ChatGPT can be a great resource when you're learning about terminology and how technology works when you don't come from a engineering or computer science background. Between those three avenues, I think it does take investment, but anyone can ramp up on it as long as they do take that time to invest in learning.
Great. Now we're transitioning to our final section of the podcast. So we end each podcast with a set of rapid fire questions. So I'll just ask you a question, say the first thing that comes to your mind. I'll take the first two and then hand it back. Are you an early bird or a night owl?
As long as I can get 9 hours of sleep, I'm a very happy type of person. Usually nowadays, that means I'm a early bird because I have a 4-year-old who likes to get up at 6 a.m. every day.
What has been the most memorable event you've attended in San Francisco?
That's a hard one. San Francisco is so dynamic and there's so many different types of events. I think just the proximity of San Francisco to kind of very different types of activities has been really fun. So I've had days where I've been able to go up to Napa for wine tasting and then go to the beach afterwards, which is, I think, a combination that is really unique to the Bay Area and San Francisco specifically. Those types of days are always magical in my mind.
And then do you have a morning or nighttime routine that you feel is either a productivity booster or something that you feel has been amazing for your general well-being?
I don't know if this is the best advice, but I actually like to check my phone for emails and my calendar before I go to bed. I just find that things pile up during the day. And if I don't take a glance and understand what my following days look like and what I'll need to focus on going into a new day, I'm just not able to start as productively as I could. In terms of well-being, probably not the best advice, but in terms of productivity, I think giving your calendar a glance and your email a glance at the end of each day is really helpful.
Great. And then final question, aside from the Bay Area, are there any regions, cities that you see the strongest potential for an emerging tech ecosystem in the next couple of years?
That's a really interesting question. And my thinking around this is I find it's very talent-based. Cities that have strong universities or strong specialties oftentimes become hubs for entrepreneurs. Any city, big or small, that has a really strong kind of academic presence or university presence, I'm very bullish on.
Great. Well, that concludes our podcast. This has been a really insightful conversation. Thank you so much for joining us.
I really enjoyed the conversation. Thank you for hosting me today.
Thank you.